TraderJud here with you for another Indicator 101 video. Today's video we will be going over the Relative Strength Index, otherwise known as the RSI. We're going to go over how the RSI is calculated, what the RSI looks like, how you view it on your charts, and how you can utilize it in your trading. So, as you see on my screen, I've already got this typed out. The RSI, or the Relative Strength Index, equation is 100 minus 100 divided by 1 plus the relative strength. The relative strength is the average gain divided by the average loss. The average gain equals the previous average gain divided by 13, or that should say x minus 1. Excuse me for that. In fact, I'm going to change that right now. It should say x minus 1, not 13. So we're going to put x minus 1 for that, and x minus 1 for that as well. Alright, so it's going to be, again, the average gain is going to equal the previous average gain divided by x minus 1 plus your current gain, or your average loss being the opposite of that, the previous average loss divided by x minus 1 plus your current loss. The previous average gain is going to be the sum of gains over x periods divided by x. Previous average loss is going to be the sum of losses over the past x periods divided by x. And for an example, we're using the RSI set to 14 for this, which is why you saw divided by 14 instead of x minus 1 up here. But the previous average gain will equal, in this example, we're using, for the previous average gain, we're using the sum of gains over the past x periods as 1.4 for the gain and 0.8 for the loss, divided by 14 because we have the RSI set to a period of 14. And that will be 0.1 for the average gain and 0.06 for the previous average loss. Taking that, those two previous average gains and applying them to the average gain and average loss, we're taking 0.1 because that is the previous average gain, dividing it by 13 because that is x minus 1, x being 14 minus 1 will give us 13, plus 0.04, which is the current gain, that equals 0.05. The average loss is 0.06 because that's what we got for the previous average loss, divided by 13 because again that's x minus 1, x being 14 because that's what we have the RSI set to, plus 0 because there was no loss for this period, and that equals 0.05 as well. RS, meaning relative strength, equals average gain divided by the average loss. 0.05 divided by 0.05 equals 1. So the RSI will be 100 minus 100 divided by 1 plus the relative strength being 1. 1 plus 1 equals 2, divided by 100 equals 50. 100 minus 50 equals 50. So the RSI for this period will be 50. So how is that shown on a chart? Let's see here. We're going to open up the indicators on TradingView. We're going to open up the RSI, Relative Strength Index, and you'll see the RSI when it pops up down here. It is already set to 14. You'll see the values over here on the side. So the value for that we just calculated will be 50 right here. And this is what it is going to look like. You'll always see the RSI in a separate window from your normal chart. This is UJ on the 4-hour time frame. And essentially what this means is that with a candlestick chart, we're taking the relative strength index from the past 14 candlesticks. So you take, again, we're not going to calculate this, but the way that it works is we're going to take the past 14 candlesticks, we're going to apply the 14th one will give us the current value, which the current value is at 42.0139 is what it looks like. So the way that is calculated, again, we've already gone over it up here, but that just takes the relative strength from the past 14 candlesticks and assigns it a value. Now, what does that mean for trading? Well, most commonly the RSI shows two things. One, it shows divergence. Divergence is used by a lot of traders. It's used in Forex, it's used in cryptocurrencies, it's used in stocks. It's used across the board. A lot of people look for divergence in the markets using RSI or a number of other indicators. It's also used for showing extreme strength or extreme weakness in the markets, and people look for that because if there's a market that's extremely strong, usually you'll see opportunities to sell, and if a market is extremely weak, usually you will see opportunities to buy. Now, that being said, just because you see the RSI in TradingView has this purple box, and that's represented between the 70 and the 30, and this is the ranging area, I guess. Most people, when it breaks out of the 70 or 30, and you can adjust these settings. I know some people like the 75 and the 25 instead of the 70 and the 30. But if it breaks out of this box, that alerts traders to be on the lookout for opportunities to sell if it breaks out of the top, or opportunities to buy if it breaks out of the bottom. That being said, I do not advise people to go about doing it this way, and here is the reason why. You'll see right here that price continue to go up. It's following market structure, it's going up, but you'll see at this point in time that the market is showing that it is extremely overbought, right? The high right here was at 83, and that would be this green bullish candlestick right here lining up with this 83. The next candlestick was a bearish engulfing candle, and that dropped the RSI way down. But you'll notice that after that bearish engulfing candle, price continued to go up. And so that is represented in the RSI again. People that would have sold after this bearish engulfing candle would have been burned. And so that's the reason why I do not enjoy looking at the RSI that way. I don't enjoy trading the RSI that way. However, if you'll notice, as price is continuing to go up here, you'll notice the RSI is continuing to go down. Looking at every single high, so we have the ultimate high on the RSI being this bullish candle right here. Then we see the RSI dip. The next high is this bullish candle right here, which you'll see is the next high in RSI, but it is lower than the previous high on the RSI. That's showing divergence. And what I mean by divergence is we're seeing higher highs on the chart, but we're seeing lower highs on the RSI. That's showing us that the strength of this pair, even though price is continuing to go up, the strength of this pair is going down. Now, the next ultimate high that you'll see is on the chart is this bullish engulfing candle right here, and that is represented with this high, which came almost right up to the 70, maybe a little bit past the 70. And then the next, and what ultimately the ultimate high was on the chart, was this pin bar right here, and we'll see that that is even lower on the RSI, topping out at 67. And so what traders will look for with the RSI as every high, what they're looking for is opportunities to see divergence within the RSI. Like I just showed you, the RSI is getting continuously lower as the chart is continuously getting higher. That's showing divergence in the market. That means that the the buyers aren't investing as much. Therefore, the strength of this pair is becoming weaker and weaker. And you can see that exponentially over here. You see all of these bullish candlesticks, that you see some bearish candlesticks, another bullish movement up, but you see more and more sellers coming into the market until you finally see a sell off. And so that's where traders are looking for, which more than likely, if you were trading this based on RSI divergence, you would be getting into a sell right about here, right when this taps the 70. Like I said, some people have it at the 75. But once this chart attempts to break back out of this I don't know, the friendly zone, if you will, this 70 to 30 zone. Once price attempts to break out of that again and fails, which we would have known that this would have failed because the next two candlesticks were bearish, even though they did not engulf this bullish engulfing candle, they were still bearish. You could have waited for a candlestick reversal on this as well, which let me be more specific on that. I'm a firm believer that you should not rely strictly on indicators for trading. Indicators are great tools, but they are not your only tools when trading. And if they are, then you need to learn how to trade properly. And what I mean by that is you need to learn fundamentals. You need to learn how to chart correctly. You need to learn how to apply more than just indicators to your trading plan to utilize that. We're looking for multiple confirmations, and with indicators, they are not the strongest confirmation that you can get when trading. And so they offer confluence, they offer confirmations, but they are not the strongest form of confirmation. Therefore, I do not recommend going that route in trading. Yes, they are great tools, and yes, that you should utilize them to some extent, but you should not rely solely on just indicators when trading. That being said, you'll see that once we saw this third touch trying to push out of here, we got the reversal pattern that we were looking for. This pin bar to the downside would have been my selling point probably. If not, then this bearish engulfing candlestick. You'll see that I have the two EMAs on here as well. What you could have done is waited for this bearish candlestick to break through, or gotten in somewhere in that bearish candlestick, because I'll show you some other strategies that you can use. Fibonacci is one of them. I'll show you multiple reasons why you could have gotten in on that pin bar. So you have the divergence with the RSI, which is what we were figuring. We also have a touch of the 61.8, which was a great indicator that this was going to go down as well. And we had, for further confirmation after we got into the trade, if you did get in on this pin bar to the downside, we have the EMAs crossing over as well. So there's multiple confirmations as to why you could get into that trade, why that trade would have been a viable trade, and you can see how the RSI helps you when determining that. Now, I'm not relying solely on the RSI or solely on the EMAs to get into that trade. I'm using candlestick analysis. As you saw, I was using Fibonacci as well. So there are multiple opportunities for confirmation before getting into a trade, and those are the most profitable trades. When you have multiple confirmations and they all line up, then you have the best odds of profiting on those trades, and that's, as traders, that's what we're looking for. So hopefully this is a good rundown of what the RSI is, how you can utilize the RSI in trading, and understanding how the RSI is figured. Again, I do not advise traders to just use indicators, but this helps show traders why indicators are useful, even though they're not the sole reason why we get into trades. So again, thank you for watching. This was TraderJud. If you enjoyed this video, hit the thumbs up, hit the like button, subscribe to the channel. I do a Forex overview every week. It goes over 10 different pairs, 3 different time frames, the daily, the weekly, and the 4-hour time frame. I give you an outlook to 10 different pairs every single week. If you have not seen that, go ahead and subscribe to the channel. Turn the notifications on. You'll get a notification every single time I post a video. I will be doing more indicator 101 videos in the future. If you have an indicator that you would like me to cover, go ahead and drop that indicator in the comments section down below. And again, thank you guys for watching. I am out.